Hey, Dan Passarelli here. Well, I was looking at stocks today, just like I do every day, looking at different stocks and indexes and volatility and such. And I noticed something that has been going on for a while. And I don't know, maybe in a way it kind of snuck below my radar, but not anymore. Let's take a look. So the S&P 500 obviously has just been growing and growing for the past 6 months, and pretty steadily with just some minor dips here or there. But if we look at the implied volatility, which is the red line here, that's been solidly above the historical volatility, which is the blue line here, since, about the middle of May, really. Now, there's a couple of nuances here, some of which we've talked about in the past. This red line here, at least on the Thinkorswim charts for the 30-day historical volatility, the way they calculate it takes into account a lot more out-of-the-money options than I guess I would do it personally, which means that this doesn't necessarily reflect actual volatility of options. It usually gives a more inflated number. So maybe this isn't as bad. Well, when I say bad, I don't necessarily mean bad, but maybe it's not as drastic as we think. So if we look at today's historical volatility, which is 7%, and we look at the implied volatility across the board, which is what the red line supposedly represents. The implied volatility is still, they're all way above 7. I mean, the 5-day ones are 9 something, but everything else is 10, 11, 12, 13, 14, 15. As a matter of fact, the December options are actually really high, trading at 18.5. All this is really decidedly above historical volatility, which means that volatility in SPY and therefore across the board is elevated and has been elevated for a while. It is, and it's been an excellent time to be selling covered calls and cash secured puts. But that gets a little bit tricky too, because when we're in a market like this, selling covered calls, we can see the stock bust through call strikes. It's not so violent with the S&P 500 that it's impossible to adjust, but some stocks that register on my radar, like BTU here, this one, implied's been above historical, really not as much in the same period. There's been a lot more volatility in the stock. But lately, that one's been challenging for covered calls. Another one we can look at too is like UUUU. Of course, coal and rare earths. And in this case, UUUU. 4 U's in a row. It's kind of hard to say that. They're in uranium as well as some rare earths. That stock really took off to the upside. And it's been a little bit of a challenge to sell covered calls in there, especially in this range where the stock was maybe moving even more than the implied volatility. So it's kind of the best of times, the worst of times. It's been a really good time to be selling, especially cash secured puts, because there we get the benefit of both Vega and Delta in a lot of stocks, but it's been a challenge in some of them that are in some of these niche industries like coal, like rare earths, that have really, and like some of the tech stocks that have really taken off to the upside. So I wanted to share this observation with you. I hope that helps. This is Dan Passarelli, Trade Smart.